What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm Beata Harasim, Senior Investment Strategist at the BlackRock Investment Institute. This week, we discuss why traditional portfolio diversifiers are being challenged and why investors may need a broader approach to diversification. Surging long-term bond yields are reinforcing one of our key views. Traditional portfolio hedges are less reliable in today's macro regime. We think investors need a plan B, built around more unique sources of return. Long-term government bond yields have surged again, with US 30-year Treasury yields reaching their highest levels in roughly 2 decades. That matters because government bonds have historically helped cushion portfolios when risk assets fall, but that role is being tested. Since the onset of the Middle East conflict, US Treasuries have come under further pressure as investors have focused on sticky inflation, energy supply risks, and persistent fiscal deficits. Gold, often viewed as an inflation hedge, has also fallen over this period. That reinforces our view that the old playbook for diversification is becoming less reliable. Why is this happening? We think markets are adjusting to a new macro regime shaped by megaforces. Geopolitical fragmentation is increasing the risk of supply shocks. Persistent fiscal deficits are putting upward pressure on long-term borrowing costs. And the AI build-out is driving major investment demand. Together, these forces point to higher for longer inflation and interest rates than the markets were used to before the pandemic. That is why we prefer short and medium-term US government bonds over long-term bonds. We also continue to like inflation-linked bonds on strategic horizons over 5 years or more. We still stay pro-risk, supported by solid corporate earnings and the AI theme. Strong earnings growth has helped equities absorb the drag from higher rates so far. But at the total portfolio level, we think investors need broader diversification sources. We favor idiosyncratic return streams, especially hedge funds and private markets, where returns are less dependent on broad stock and bond market moves. Here's our market take. Traditional portfolio diversification is being challenged as long-term bond yields rise and old safe havens prove less reliable. We think investors need a plan B, using broader sources of return while staying pro-risk on solid earnings and the AI theme. For details, read our weekly market commentary. Go to www.blackrock.com/weekly commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.